All right, folks, here it is. This one has been being asked of me for a long time. So those of you that don't know me, I'm Chris Naugle. I'm known as America's #1 money mentor. Not going to get into the whole story, but spent about 16 years as a high-level financial advisor, retired in 2018, and I have been doing privatized banking ever since. Also the author of Mapping Out the Millionaire Mystery. Me and Brent Kessler wrote that book all about the infinite banking concept. And here's what we're going to go over today. The biggest thing that I'm asked, IUL or whole life. Why shouldn't we use indexed universal life over whole life? Which is better? Why are they better? Why do you have such a strong standpoint on IULs? And you know what? In just a few moments, we're going to cover that. And we're going to go deep, folks. We're going to go deep into this topic. All right, I feel like this is like the battle royale right now. I have done so much homework, but I really didn't need to. I just wanted facts. You know, the difference between these two vehicles is one of massive proportion and is one that there's not enough people explaining these differences. You see, I am huge on the infinite banking concept. And there's some people saying the infinite banking concept works better with indexed UL. And I will absolutely fight that one to the grave because no way that works. But what is indexed universal life? Where did indexed universal life even come from? So let's take a trip back in history. Spent 16 years as an advisor. I knew these products. I knew all about these products. I've studied and sold these products. So IULs spawned from a vehicle called a variable universal life, a VUL, one of which I own. VULs were also created from a product called the universal life, which were created in the late, well, actually probably the 80s. We'll say that they were created. They came about in the late 70s, but they really took popularity in the 80s because of high interest rates. What universal life did is took the traditional whole life model and said, we want a permanent life insurance plan, one that will never end. That's what permanent means. There's term and there's permanent, right? Term insurance is for a term of time. Permanent insurance is forever, or is it? Universal life took the concept of a whole life, which is around for your whole life. And they said, we want to make a product that mimics a whole life, but also mimics a term policy from a cost standpoint. So they took a term policy, an increasing term policy. So increasing means the internal cost as you get older, get more expensive. They put it inside of a permanent little wrapper, a wrapper that would basically make this to last forever. And then they threw an interest rate to it. The original universal life plans had some form of a guaranteed interest rate, 2%, 3%, 4%. So the old ones had guarantees of 4%, of which mine has a guarantee of 3%. The universal life plan I bought in 2003 was called an accumulator. It was a good plan from a great mutually owned insurance company. However, when I bought it, interest rates were much higher than they are today. And universal lives float with the interest rates. See where I'm going? So if interest rates were higher then and interest rates are lower today, is my plan performing better or worse than it did when it was illustrated and shown to me? The answer is worse. And the second question, in this universal life, as I get older, I was in my 20s then, I'm in my 40s now. Did the cost of the insurance internally get more expensive or did it get cheaper? Of course it got more expensive. The internal costs go up in a universal life as I get older, but that should be okay because interest rates should have stayed higher, right? Wrong. It went the opposite direction. I still have the plan because I'm going to keep it and roll it, but you know what? The plan eventually is going to cost me more money than I am putting into it today. I understand that. Then rolls around variable universal life. In the bull markets, back when I did this in the 2000s, prior to the 2008 recession, it seemed like the stock market was never going to stop going up. Doesn't it sort of feel that way today in 2020? It does, and we're going to get there. So back when that was happening, they said, let's take this universal life and let's create a variable side. Let's put this money in the stock market so you can have the increased appreciation of whatever basket of mutual funds you put your money into. And I loved it. I'm like, yes, buy term, invest the difference in one pretty little wrapper. Sign me up. So I did it. And I still have that plan today, but I almost didn't, because as things were going in the early 2000s, when I took this one out, right after that universal life, I was putting money into it. And you know what happened in 2008, right? The bottom fell out and the market crashed. And when the market crashed, what happened to my universal life? My variable universal life is what I'm talking about. It crashed and burned. My cash value dropped 50%. My internal costs were more than the cash value that I had in the plan. And the plan, by its contract, should have lapsed, which means I had this plan that I put all this money into. And you know what? I was in danger of losing the plan through lapsing. Luckily, the mutually owned insurance company that I was with held me and held that plan and made it so that that plan didn't lapse. And I still have it today. It doesn't perform very well because the internal costs are high. So why do people like variable universal life? Well, they're untapped for how high the return can go. So the last couple of years, I've probably done quite well with it. However, I got all my money out of all those mutual funds into the fixed account, which the fixed account surprisingly pays me 3%. And I've got the money just sitting there now because I think the stock market's going straight down the tank. And you already know because you've heard me talk about this. Then after 2008, when the whole bottom fell out of these VULs and people didn't want this risky vehicle as part of their life insurance, out comes the saving grace, indexed universal life. I get the upside to a certain level, let's call it 12%. I get a cap on the downside. Where could you go wrong? It was the ultimate vehicle. The brokerages were like, yes, I want more of these. And this whole time, whole life insurance is just chugging along, doing what it's doing, making its guaranteed 4%, paying you a dividend every year. But no one talked about that. It wasn't sexy. These plans were sexy, like, really sexy. And when they came out, the brokerages and the consultants made us think that these things were the second coming to the financial world. Not only did we get our life insurance, so we had the protection and the legacy we wanted, we had the ability to capture some upside because the insurance company had a basket of mutual funds, an index, if you will, that they invested in, and they allowed us to share in those returns. But there was a premium load. And we'll talk about that as a negative. But then if the market tanked, my plan, my IUL, which I did not have one of those, I wouldn't buy one, had a floor. How much is the floor? I don't know. All of them are different. 0.7, 1%, even if it was 2%, you can't go lower than that. But you see, we've missed the underlying problem here with these plans. The underlying problem is inside this plan. Inside the inner workings of this thing that no one ever sees, that the brokers don't typically tell you about, are fees, and more fees. Just like the VULs, the IULs have all sorts of added fees to make them operate. So that's why the insurance companies love them. That's why the brokerages love them. And that's why they sell them to you. Big old fat commission. So let's dive into this, but that's just my opinion. So let's get into the factual data that I found by researching all the facts on IULs. Lots and lots of pages here, folks. So let's just do it this way. Let's talk about IULs, pros and cons, versus whole life, pros and cons. And I'm going to try to keep an absolute neutral stance on this, okay? Because I want you to understand how I feel about this. And I also want you to understand the facts from all this research that my team has put together. And also, we're 16 years of being a financial advisor, selling products like this, having consultants teach me about products like this. Let's look at what that actually spells out. So what are some of the pros of an IUL? Well, some of the pros is market, right? We get the upside of the market. So let's write down market upside. That's a pro. So we got that. We have the ability to capture some of the stock market's upside if it keeps going up. This is 2020, okay? COVID year. Where's the market going? Is it just going to keep going up and up and up to eternity? Are we going to make it to Mars? Well, I hope you are all smart enough to realize that it's not going to keep going up. Matter of fact, I'll tell you, it's going down. So do you want a vehicle that captured market upside? Well, I certainly wouldn't, but let's look at that as a pro. So it's got a market upside. Okay, it also has a market downside. Okay, a market floor, let's put. That's a pro. So if the market goes up, we have the ability to make some type of differential of what the stock market does. Let's say it's an index that the stock or that the insurance company puts on it. Right here, your rate of interest is based on a market index chosen by your insurer. I'm always talking about controlling your money. Does that sound like you're in control of your money there? Well, anyway, this differs from universal life policies, which the Insurance Information Institute says earns an interest similar to that of a money market account. So, and then also talks about the Securities and Exchange Commission. Now, let's keep going into this about this market upside. Your insurer, not you, your insurer selects the index. And then they calculate an interest based on the performance of the index, okay? Based on the performance of the index. So you're not getting dollar for dollar what the index does. Some insurance companies might give you that, but most do not. And then the life insurance company then credits that to the interest in your cash value account. Okay, so the interest rate guarantee. What is that interest rate guarantee? Well, there's an upper and a lower. The upside, I don't know, I've seen 12% a lot. And the downside, the floor, I see 70 basis points quite a bit, okay? 70 bips. And if you don't know what bips are, it's a fraction of a percent. Easier way to write it would be your floor would be about 0.007, okay? 007. There you go. That's 70 basis points. So, but then there's a con. We got to get the cons out of the way. So what is the con to this market upside? Well, let's talk about that because it's very simply put called participation rate. It's right here, folks. Participation rate. So what is participation rate? Well, that is based on the market upside of the index. The insurance company is going to give you a participation rate. It can be anywhere from 25% to more than 100%, depending on the insurer. So pick wisely. For example, if your gain is 6%. So let's do this over here, folks. Let's do another page. So this is the IUL, okay? And this is your participation rate, okay? Participation, that's a long word, rate. Hopefully I spelled that right. If not, who cares? We're not caring about spelling, but I get my math right all the time. So let's just say the index that your IUL insurer invests you in, okay, earns 6%. Now let's just say your participation rate is 50%. This is your participation rate. They don't talk about this, do they? They don't explain this. Your participation rate is 50%, which means you are going to get 50% of the 6, which means you essentially made 3. So if you invested $10,000 into your IUL with a 50% participation rate, how much did you make? 6? No, you made 3. You made $300, okay? Now, I'm not saying all IUL plans do this. Not all IUL plans have participation rates that are 50, but can they? Yes. Can they have as low as 25%? Yes, they can. But let's get back to the facts, okay? So participation rate is something you need to be considered. Another disadvantage is of this, okay? There are caps. The cap, okay? So let's write down there's a cap. So your upside is only 12, and they're going to cap you to whatever, 12%, okay? So you're going to get a market upside cap. Not really a big one, but it sets a maximum participation rate. So that's another negative. What else? Let's look at some of the pros, shall we? I got a whole sheet of pros because I really want to talk about the good things here because it's so easy for me to rip these things apart. Oh, and I plan on it. Trust me, I'm just kind of warming up right now. So the guarantees in the plan are true. So you have guaranteed benefits, okay? So you got benefits that are guaranteed inside this contract. The other thing, I do like this, folks. I like this. Flexibility of premiums. Okay, so I start a plan with 10,000, but then I can reduce it down to 5. Yes, but that also is a double-edged sword. If you read your contract carefully, so let's come over here to the cons because this is both. I'm going to write the same thing over here. So, Chris, why would I write the same thing as a con and a pro? Because if you have the flexibility, okay, to change your premium so does the insurance company, meaning the insurance company can set your premium at $10,000. And then a couple of years later, 10, 15 years later, they can change your premium. So the insurance company also has flexibility of premium. That is not good. We're going to get into that a little bit, but let's keep going with the positives here, folks, because we're on a roll with positives. We got some guaranteed benefits. We got a floor on that market, maybe 70 bips could be up to 1%. I mean, it could be anywhere. But what other positives do we have? We have the option to borrow. Okay. Well, you know what? We got to kind of look at some of these positives, and we got to start then looking at what some of the pros are with a whole life. But we have the option to borrow against the plan. What else over here are some cons? So let's get this side done, and then we're going to really kind of dive into this thing and do it. So what are some of the other things? Over here, some of the cons of it is up here you have market upside, but you are 100% basing your plan on the market. Okay, that's a negative for sure, because if the market goes down, you might have a floor, but does that mean you make anything? No. And actually, that's right where the problem begins, and we will get there in a second. One of the biggest cons, and I'm going to write it as big as I can, are fees. Okay, this is the biggest problem with these vehicles. Fees, and more fees. And I will outline all of those fees. I've got them all written down for you, just so you understand what those fees are, all right here. Okay, but what else? What are some negatives? Okay, higher expenses. So, well, that's kind of fees, but the expenses and the fees are really different. One of the biggest, rising cost. I'm going to do COI, rising cost of insurance. I'm out of room on the con side, and I still have some more. They're complex. They use derivatives. They use an algorithm on the investments. That's why we have to get that participation rate. And I put that up there. So you see, we've got a negative is the participation rate. You're capped to maybe 12%, some type of a cap. The insurance company also has the flexibility to raise your premiums. Okay? You're basing everything on the market right now at the all-time highest point in the market. What else? Fees, and more fees, and expenses. Fees and expenses. Rising cost of insurance. A lot of negatives, but these are the greatest thing everybody tells you. One other one I forgot, and I got to kind of write it over here. Surrender fees. Now, I know I already hit fees, but this is important. So we got surrender fees. Those are really a big problem. Okay, let's come over here to whole life, because is there pros and cons to a whole life? 100%. What are some of the pros? Guaranteed. Okay, all the plans we do, you guaranteed to make 4%. Guaranteed benefits. Okay, so your benefits are guaranteed. What's another pro? Level cost of insurance. Your cost of insurance never ever goes up. Okay, pro, you can borrow. So what did I write over here? Option to borrow. I'm going to write that here. It's the same. Option to borrow money. You can take your money out anytime. What else? You can actually have a fully paid up plan. Okay, so fully paid up plan. So what that means is you can basically design the plan to be fully paid up at some point in time. What else happens? Let's see, option to borrow against cash. I'm just looking for some of these. Now, that's it. Now, let's go into some of the negatives, right? So there's a lot more pros to this, but really, I hit them. And dividends. Gosh, how did I forget that? Dividends are paid. So the insurance company, mutually owned insurance companies, will share their surplus with you in the form of a dividend. So that's a pro. But what are the cons? What are the negatives? Everybody wants to hear the negatives. Well, there's no market upside. That's a big negative, right? No market upside. You can't go up with market. It's that boring old 4% plus dividend. Okay, that's a negative. Okay, what other negatives are there? Well, let's see. Cost. Okay, I guess the cost. We'll talk about that. How much are the costs? Well, the companies we deal with are $50 to $100 per year in policy service fees. Okay, but what else is there? There's a cost of insurance, but that cost of insurance is level. Remember I said level cost of insurance? Very important. Now over here, you don't have a level cost of insurance. You have a rising cost of insurance. But down here, a lot of people will make you believe that the cost of insurance is less in an IUL because it is in the early years. Over here, you notice I put cost of insurance. okay? Your cost of insurance over here is higher in the early years. So your initial cost is higher, but if it never goes up and this one goes up, which would you prefer? Would you prefer one with a higher cost of insurance today that never goes up for as long as you live? It's always the same till the day you die. Or would you want one that as you get older, as you approach some of the things that you're trying to save for, whether it's retirement or college, that your internal costs keep getting more? That's for you to decide, really, not for me. Okay, what other things are some negatives about whole life? Well, let's see. The way we design them, the banking policy, so there's a limited number of companies, limited options for companies to do banking. I'll just write IBC. There's not a lot of companies that we can use for IBC. So we got limited. The cost of insurance is higher initially. So I got to be clear about that initially. And there's definitely no market upside. So we got rid of some of those. So what other problems do we have with these vehicles? What are some of the other things that we really need to hit on? Well, let's go into it. Let's talk just about these things that we have here, okay? What I want to do is real quickly, I want to draw you where we're at. This is the stock market, okay? And then over here, what I'm going to do, well, purple's the wrong color because that doesn't represent what we're dealing with here. Let's put red, okay? This was March, okay? And we went down in March. Terrible line. Come on, Chris, draw it right. And then we bounce back up, and here we are at the very top. X marks today. So this is today. What are we at? Today is 11/27/20. Okay, this was March 2020. This was the COVID drop, we'll call it. The market tanked. I think it was 30+%. Okay, plus. And then we came back up. This is the rally. This is the little stock market rally that we've been dealing with. So right now, do you want to buy an index at the highest point the market's ever been? What did Warren Buffett say? Warren Buffett said, buy low, okay, sell high. What was the last thing he said? Rule number 1, buy low. Rule number 2, sell high. Rule number 3, easy. Don't lose money. So what we should do, according to the brokers and all the people talking about these IUL plans, is we should put money in the IUL right now at the highest point in the market so that when the market does go down, and folks, it will, okay? It will go down. I just don't know when. So when is the question mark? Because no one can time the market. But when it does, we literally put our money into a vehicle at the highest market point ever. Now, some people would say, yeah, but Chris, why not keep putting money in? I'm buying low. Okay, I'm buying low. I'm dollar cost averaging in. Touche. Touche. And you're absolutely correct. Let's go back over here. In this study that I did, okay, where I was talking about fees, IULs have the highest fees of any insurance policy. Fact, right here, folks, right here. Highest, it's the most expensive type of insurance that you can buy. All right, so what else? What are some of the other truths here? Okay, when it comes to IULs, let's go into this. So again, do you want to buy at the highest point ever in the market in anticipation and just hoping and praying that it just keeps going up? I don't, and I won't. I never will. I buy low. I bought here, folks, and I'm going to buy somewhere around here. I can't pick where, but that's where I'm going to buy. So that is another reason why an IUL is a terrible vehicle to look at right now. But what else? What else? Okay, a lot of times with these IULs, and I wish I had all the numbers to show you, but I'm just conceptually giving it to you. You know, they say you can't lose money. Okay, in an IUL, you can't lose money. That is false. Absolutely false. You certainly can lose money. Oh, no, I can't, Chris. I'm guaranteed, basically, I'm guaranteed a floor of, let's just call it 1%. I got a floor, Chris, of 1%. Yeah, you got a ceiling of 12 and a floor of 1%. So I can't lose money. You can't lose money in the market, but your plan can absolutely lose money. Because remember, we seem to always forget about the fees. What fees do we have? Now we get to my fun stuff, folks. Well, there's a premium load, okay? Now, Does whole life have a premium load? Yes. If you pay monthly, the insurance company charges you more to pay monthly, but that's a fee. So this is the same, whole life and universal life, IUL. Okay, what other fees are there? Whoops, here we go. There's annual expense charges. Does a whole life have an annual expense charge? No. A whole life has an annual policy service fee, and usually it's $50 to $100. This annual expense charge is related to the investments. What else do you have in these? Okay, you also have additional mortality. So you have mortality charges. Okay. Now this some people would say is cost of insurance, and yes, whole life has it, but IUL has a rising cost every year that you get older. Unless you can tell me that you're not going to get older, every year you get older, your cost of insurance is going up. Do you want to put all your money, or do you want to put your savings into a vehicle that has costs that just keep going up as you get older? It's a losing bet. You are going to get older, and if you do this IUL thing, your costs are going to go up. No ifs, ands, or buts about it. I told you the insurance company has the flexibility to raise your premiums. That's why. What other expenses do we have? Well, the worst one, surrender fees. This is, in my opinion, the number one reason why this vehicle will not work for anything that we do. And there's other expenses. There's admin charges, okay? There's admin charges. So we got lots of fees here. So if we take all of these fees and we basically put them into this vehicle here, where let's say right now, let's say we're at the floor. Let's just hypothetically say we're down at the floor. Are our expenses here more than 1%? Absolutely. Let's say your expenses are 2%, okay? But you got a floor of 1. What is 2 minus 1? Okay? Plus 1 to the insurance company. Do I want plus 1 to the insurance company? No, I want plus 1 to me. To me, not to them. So how I use this system, this infinite banking concept, is I put money into the whole life. Let's do this real quick, okay? Let me show you what I do. It's very simple. Go over here. Let's just use it. Let's use this one, okay? Here's what I do with my plan. This is my whole life, okay? My whole life plan. This is my bank, me, my bank. I put money in. Let's say I put $10,000 into my bank. I then immediately, within the first 30 days, I take my money out. Now, how much can I take out? The answer is 60 to 90% immediately. Why is there such a range? Because there's different plans. I have both. I have the majority of my plans gave me access to 60% in the beginning, but I just started one plan that gives me access to 90% immediately in the first 30 days. So if I do that, I take that money out, I park it in my bank account, and then what do? I use it to buy cars. I use it to pay off debt. I want to get rid of debt. I want to then recapture the money. So my wife's car payment, $980, I pay that money back to myself. So BYOB, be the bank. Be your own bank. This is it. I'm taking the $980 that I used to give to somebody else and I'm giving it back to myself. But could I do this if I don't have access to my money? No, I could not do this if I don't have access to my money. Over here, what did I say the biggest problem was? Surrender fees. Over here, do I want to be in a vehicle that has the potential to be bought at the highest point? Also, then when I want to take money out to do the things, if I'm at the low point because the market's going down to a negative, I'm at the floor, but it's okay. My advisor said, I have a floor. I can't go any lower than the floor, so I'm good. No, you're not. You forgot about the expenses, the fees, the internal stuff. Yeah, but Chris, then if I need the money, I can take it out. No, you can't. There's surrender fees, okay? And each plan's different, but surrender fees can be, I don't know, probably 6 years, 7 years. They could probably be up to as much as 11 years. What does that mean? That means if I put that same 10,000 in, I can't take that much out, okay? The whole life, you still get paid on every single penny of the money in there, just like the IUL, but it's market-based versus guaranteed. My whole life is guaranteed. The IUL, not guaranteed. The floor is guaranteed, but I just showed you that even though it's guaranteed, you still very much could lose money. And it's right here, folks. Okay. okay, tied to the performance of the stock market. Can your cash value go down? Well, they will tell you it can't, but you got to wake up because it's right here. It can. Yes, they are based on projections. They are non-guaranteed values, and the guarantees, the bare bone minimum rate, your policy will fall. Your cash value will go down if you're at the floor, and your fees will eat you alive. Now, is it likely to say that the stock market's going to always stay at that low point that we just showed? No, it's not. But could this be 2 years? Sure. Could it be 3 years? Sure. I mean, for 2 to 3 years, you're going to hemorrhage money. You're going to suffer in a whole life. Does it matter what the stock market does? No, folks. In a whole life, none of this matters because it's got the big G stamp to it. And that big G is guaranteed. We don't care in a whole life what happens. But the surrender charges definitely limit our access to cash. Again, I'm always talking about the word right here, okay? Control. If the insurance company limits the access to your cash, who is in control? You or the insurance company? The insurance company, it's right there, folks. It's right there. Then it had a big list of all the things. Here's some other things. Minimum crediting rate is not net of fees. Not net of fees. I already went over that, okay? Folks, all this stuff I'm telling you is right here. Even if you cannot lose in the index, in the market, you can't lose in the market, your increased fees and costs can deplete your cash value. The internal costs of the policy are what you don't know. That's what's hidden behind the curtain. That's what's hidden in the depths that you don't see. That's why you get a big prospectus. You get a prospectus for the whole life? No, it's boring. You make 4% plus the dividend, but you make it uninterrupted. Your money keeps building and building and building, and you can access how much? How much? I just told you. You can access 60 to 90% of your money in the whole life. So where do we want to go? Flexible premiums. The insurance company also reserves the right, and they can change it in the other direction, requiring you to put more dollars into the IUL. Not the whole life. The whole life's cost of insurance is completely level. The fee structure, completely the same. Policy service fee, $50 to $100 a year, and your cost of insurance, identical every single year, as long as you don't put riders on it. But we're designing race cars, folks, specially designed and engineered whole lives that work for banking. We're not designing whole lives with all these other riders that slow my car down. I need my machine to be fast and efficient, which is how we design our whole life. Okay, and this thing just keeps going on. So the policy has a rising internal cost, which makes it more expensive to maintain the longer it's in force. It seems backwards. Why do I want something that costs more the longer I have it? Especially something that I want for a very long period of time, because the legacy, I want someone in my family to get paid the death benefit. And if the cost keeps going up and up and up, and things don't work exactly how I want them to work, how will that vehicle, the IUL, work for me? It probably won't, but maybe it will. Do you want to speculate on your legacy? Do you want to speculate on your money? Do you want to speculate on your financial future? I don't. I want my financial future to be golden. And let's see, what else do I got? I got so much good stuff here. Too much to get into this. Universal life's become insufficient to cover the cost. So how about this? Okay, how about this? Everything we were talking about, you got an IUL. You have this thing, it's for retirement. So you buy yourself an IUL for retirement. You're like, yeah, but Chris, I don't mind about those surrender fees because my retirement's not for 20 years. Then all of a sudden, 20 years comes. You rode the roller coaster of the stock market, okay? And here you are. This is your retirement year. 20 years down the line, you're right here. Your market's down. But what happened? Did your cost of insurance go up every single year? Every year you got older. What was your cost of insurance? Well, it was low when you started. Oh, then it got more expensive. Oh no, it gets more expensive. Every single year I get older, my costs keep going up and up. And then here I am, X marks the spot, retirement, market's down, costs are high. How's my retirement looking now, folks? Just like everything else that's market-based. Unpredictable, unsure, speculation, and you are not in control again. So the costs rise and the high premiums are inadequate. What can happen to your plan? Let's just say here, you're getting ready to retire. You want your costs to go down, not up. and all of a sudden the market takes it down. You don't want to put more money. The insurance company says, Mr. and Mrs. Smith, your IUL will now cost you $1,000 a month. But you're just getting ready to retire. No. I was supposed to not have to put any more money into this plan. Oh, no, I'm sorry. But because of your cost of insurance and because your performance of your index, which you weren't in control of, didn't perform quite as well as we anticipated as that hypothetical illustration, you now have to pay this. Well, I can't. What happens if I don't pay this? Great, your plan will lapse. This is exactly what almost happened to my VUL in 2008, folks. When people tell me that they want to go and battle royale or they want a Royal Rumble in regards to IUL versus whole life, folks, line me up, give me the gloves, and I'm ready to go because I have done my research. I have seen these work. I have seen what way these go. All I'll tell you, if you want to do banking, if you want to control your money, you want to have access to your money, you don't want to worry about the markets going up. You want to be able to put your money in, make interest, uninterrupted compound interest, what Albert Einstein called the eighth wonder of the world. You want to earn that, and you want guarantees. You want things to be predictable in your future. You want to know how much money you're going to have in the future, and you want to know what your goals are going to be, or what goals are going to be taken care of with this machine. Folks, I got to tell you, I think we went through that. The winner of the Royal Rumble is undisputed champ, whole life. Why? Look at the past. What has always been the choice of the wealthy? IUL or whole life? The answer is whole life. It has always been the choice of the wealthy. What have banks always used for their tier one capital? What are they the number one purchasers of? Is it IUL or is it whole life? Whole life always has been, always will be, because it's guaranteed. Where do you want your money? Do you want your money in a vehicle that the insurance company gives you a bunch of moving parts, a bunch of rising in cost, or do you want your money in the steady eddy where the wealthy put their money? That's your decision. All I'm here to do is to show you the difference between IUL and whole life so you can make an accurate decision. All this information is online. You can look it up yourself. I did my homework. And you know what? My money, my life, my goals will always be with a mutually owned insurance company, whole life policy. Folks, I hope you enjoyed this. We'll see you on the next one.